Rightio, it's time to get into some formalities. So look, I promise not to keep you away from your socialising for too long. But as we all know, when you get shouted free food and grog, the price is that you got to shut up and listen to us for a little bit. So look, I'd like to welcome everybody here tonight. Thanks for coming along. Come up a bit closer. Come on, everybody. Don't be shy. So look, as I said, welcome everybody. It's great to see you all here. Great to see such a crowd here to support us. So thank you. It's also great to see so many familiar, smiling faces. So a lot of you are known to me. Just a couple of acknowledgements to start with, I guess the first cab off the rank is just to those that have made this possible tonight. Firstly, Melanie has just disappeared out the door. My assistant Melanie Quinn here. Nicole Smith we've got here from the Classic Marketing Department. So Nicole and her team and Melanie have really done a great job to pull all this together at reasonably short notice. So thank you guys. The other thing I think I might just mention is that this is definitely an apolitical event tonight. Having said that, we have in the room a couple of politicians, and Sam Uffindell, National Party candidate for the Tauranga by-election, and Cameron Luxton, ACT Party candidate for that election. So welcome to you two guys. You're both guests of other invitees here, but I wish you both well in the election coming up. I'm sure that you will be hanging on every word about property that we speak about tonight, but I'm also sure that you'll be more than happy to have a chat to anybody that wants to come up and have a bit of a chinwag about politics and other things. As for myself, I feel like I don't really need to introduce myself. And the reason for that, I should mention hastily, is that all of you here tonight have been personally invited by me, or you are a guest of someone who I've invited. But a good number of you I've known since my previous life as a partner at Cooney Lees Morgan. And many of you are also either involved in or about to become involved in one of these collectives that we're going to talk about tonight. Who's on the technology? I bailed out of that one, so for obvious reasons. So Classic Collectives Limited, I mean, who are we? Gee, look at those good-looking people there. So Classic Collectives Limited is a joint venture business established by myself, Daniel Watkins, Matt Lagerberg and Peter Cooney. Daniel, you'll hear from Daniel shortly. He's going to give us some wise words and facts and figures around commercial property. Daniel's been the director, the manager of the developments division of Classic Group for a number of years, and what he doesn't know about property is not worth knowing about, or commercial property that is. Matt and Pete, as I think probably everybody will know, Matt and Pete are the founders and the current owners of Classic Group. We also have on the team young Kane Dew down here. Kane has joined us in recent times, fresh from his studies in Auckland. Kane comes from a well-known property family here in town. and his primary responsibility is the management of the properties that we manage currently under the banner of Classic Asset Management Limited. I think last tally up was there's about 20 odd properties that Kane is managing, with a total rent portfolio of around, turnover of around 6 million per annum. Melanie I've already mentioned. Melanie works part-time for me in the Classic Collectives team, and that's in the time that she has available for when she's not running her Day of Magic charity. I'm sure Mel would love to talk to someone about her charity at some stage. Liam Geraghty. Liam's the Chief Financial Officer of Classic Group, but in that capacity he certainly lends a good hand to us with our accounting and admin. Catherine McArdle. Catherine's a legal executive. She was at Cooney Lees once upon a time, working in my team, and after taking some time off, she's decided to come back and work in our little old office here at the Mount. So that's the team. So we've talked about this collective concept, and look, I guess I like to think of these groups of people that we're putting together to own these assets as little tribes, and that come together with a common cause and common purpose, and have a bit of contact with each other and some input into what's going on. And so what we've endeavoured to do is just articulate just what a collective is. And I guess the main reason for that is just to distinguish it from the common, what is known as a syndicate. We are wanting to just have a little bit of a point of difference to what a syndicate is, and that's why we go under the banner of collectives. So, as you can see from the screen, Classic Collectives is an opportunity to invest and participate in premium commercial property assets with regular monthly income and growth potential that you might not achieve as an individual by pooling resources with other like-minded people in an independently managed structure, supported by knowledgeable and experienced property experts. So that's what we've endeavoured to, as I say, articulate as being what it is that we do and what it is that we offer to the people that wish to be involved with us. I think to put some perspective into that, I thought I'd tell a little story about where it all, this concept really all started. Those of you that have heard some of my little stories before, don't worry, I'm not going to waffle too much. But this is really where it all started. This beast of a thing here, which was it's a real goodie. And it's back in 2011, 2012, I think it was. My mother and brother, Terry, who's here tonight somewhere, my mother and brother were looking at putting some money into their own little commercial property. And so Terry and I had a look around here locally to see what we could find. There was nothing really that took our fancy, so we cast our net a little wider and went to the Waikato, even went to Northland, I think. And just being able to find anything in that price range that a mother and son could afford was it just wasn't possible. Till one day, a real estate agent that we had made contact with rang me up one day and put this beast of a thing in front of me and said, "What about this?" And I thought, yeah, that's pretty cool. 50 in a brand new building, is developed as part of a wider shopping centre in a really good catchment. NZX listed company, 15-year lease. That was all. That all ticked all our boxes. The only thing is that it had a $13+ million price tag on it. And at the time we had been dealing with Mark Thomas at KPMG just here locally about some of our financial stuff. And I happened to mention to Mark that, gee, this is a pretty good asset, but we're not going to. There's no way we can afford it. So look, long story short was Mark had some clients that were in the same position as some of my family members. They were looking for something. They were open to pooling their money together, and we basically made it happen. The other dynamic there at play was the bank. I think it was ASB, who had financed the whole development, had said to the real estate agent that we were dealing with that they would be really keen to finance a purchaser into this asset. So, between a group of, private individuals and a bank, we made this happen, and it proved to be a really quite a stunning investment. And it was sort of from there that I started thinking about some of the fundamentals and dynamics that were at play. So, Kane, can you just... And I thought I just share that with you all tonight because those dynamics that were at play then, have been brought forward to some of these other things we've been doing. And I know it probably sounds reasonably simplistic, but often the good things are nice and simple. And I mean, obviously, the first and foremost was, just the power of a collective, the power of a group of ordinary people who were prepared to pool their resources and become an owner of an asset that they might never have been able to own individually. And that's, we've seen a lot more of this sort of stuff, obviously, with some of the bigger syndicators, same sort of principle. But as I say, the overriding feature of what we do is smaller groups with a little bit more personal transparency and input. The power of leverage, I think a lot of people, I guess particularly, my generation and older are a bit scared of debt. But debt, if you use it properly, is a really good thing. So we were able to buy that property, that warehouse property I've just shown, $13 million. We only had to find half of that money because the bank was prepared to be the other partner. And that's a pretty easy partner to find. And I think the thing I should say there is that this debt that we use is what they call non-recourse. So there's no personal guarantees, there's no personal liability directly by any investor to the bank because of the way we leverage the debt to value ratio. The bank's happy just to rely on the asset as its security. The other thing that I think is really important, and it's something that we really focus on with the stuff that we do now, is I've got up there power of strategic planning. That should really say the power of a long WALT or a long lease together with strategic planning. That example I've just shown you, we actually exited that property after 5 years or 5 or 6 years. And we were able to do that because there was a good long lease in place and there was plenty of term still left to sell into the market. And there were other strategic reasons that that we decided to exit. And that all comes about with the sort of the annual AGM process that we use, and we bring the strategic focus to that so that we can plan ahead. Yeah, the power of the mum test. So I said my mum was involved in the first one of these projects. She's been in 2 or 3. Don't really know whether she knows whether she has or not, but my siblings do know, so I'm held to account there. But yeah, it's something that we've sort of brought through to what we do now. It's really simple. Might sound a bit corny, but it's a really good grounding to when we look at something to say, hey, would we put our mum into this? And I have to say, I'm happy to put my hand up, and we've looked at some product, and one of my co-directors, usually either Pete or Matt, will say, is mum going to go into this? And that's usually, that has been a good, as I say, test as to whether to ditch something or not. So those are, there's other dynamics at play, obviously, in terms of rent review mechanisms and then that sort of thing, which I think Daniel will touch on more. But I sort of think that those were the sort of the light bulb kind of moments I took out of that first project that I talked about. So since then we've done a few other things. These are mainly just under the banner of Classic Collectives. Some of you are involved in some other projects that we haven't done under Classic Collectives, done under my old, as I say, my old life. But there's the Countdown in Pokeno. There's the Downer site just up here in Totara Street, and the just newly completed NZ Windows building in Tauriko, which I think you'll find Daniel might touch on. And there's another one there. It's one of the pipeline properties that we're talking that we might mention also in Tauranga. So we've got a few of these under our belt now. How's my time going, guys? This is just a basic investment structure that we use just to show that that it is a glorified partnership really between the owners, the bank, the tenant, asset manager, and the manager of the partnership. So and what comes out of that really a key. Thanks, Kane. Some key fundamentals. I've talked about the non-recourse loan, really important. People putting money into these projects, they don't want to be caught up with bank guarantees and things. Independent management is absolutely critical because it is, means that the property's being managed properly, and the investors don't have to have any day-to-day drama themselves. Strategic focus and review I've talked about. The owners do get input in our model. And there is, we always build an exit mechanism in, and we use, in terms of limited liability, we use the limited partnership structure, which which is like a company. That means that you don't have any, the investors don't have any liability during the course of the business. What do we got next, Kane? So look, the other thing, we were going to get Mark, get somebody independent here to just have a bit of a yarn and talk about economic fundamentals and what's going on out there at the moment. And was obviously wanted to stay local, which was how we like to play things. Mark Lister was keen, can't make it tonight. But two things. One, he's given us a slide I'll just very, very briefly talk to. And he's indicated that he'd love to come and do one of these things with a bit more focus on the economy generally. So if you keep your eyes open for an invite to that at some stage in the near, a little bit later in the year probably. So he's got some comments there which were probably all heard before of what's going on in the economy. The impact of interest rates and inflation and so on and so forth. In terms of an investment strategy is talking about looking at quality assets with long-term structural tailwinds, and obviously, property is one of those assets that he touches on there in terms of superior locations, high tenant quality, and long lease terms. And I think Daniel will speak to that in a bit more detail. What's the next one, Kay? And I think the last message on the right is the key message in my view, which is, when you're thinking about investment, it's for the long term. It's not for what's happening now. It's looking through the ups and downs and sort of understanding where the end game is. Okay, so Dan, I think that's you, mate. You're up.
Thanks, Owen. Hopefully I won't take as long as you did. Far away, Kane. So I'm just going to talk about inflation and what we're seeing on a day-to-day basis at the moment. There's a lot of talk about interest rates at the moment, and I guess how that's impacting property, but there's not so much about the building value. And I've put an example over here on the screen here. That's the NZ Windows building that we've just syndicated. So basically the costings on the left are what it cost us at the time, which was about 18 months, 2 years ago, in terms of land value, build cost, design, interest, all factors in, which there's sort of total cost of about 10.5 million, which we were able to put it out at a rent around, it was about 578k. To do that same building now in Tauriko, you're having to pay 7.5 million for the land. Your build costs are nearly 2 million plus more than where they were 12, 18 months ago, plus all your other costs moving with your interest, build costs, and obviously having to allow bigger contingencies around that exposure with the market and what's happening. So to replace that same building, which I think has been sold for about 13 million as an end value to investors, to replace that same asset now is close to 17 million dollars if you were to do it today. So what we're seeing, I guess, is these huge cost inflations, and that existing stock, I guess, is that it's potentially well undervalued in terms of if you had to go and build it from new today, from scratch. There's a huge difference in where your rent would have to be to make it viable. So I guess that's kind of where we've said that existing values in our eyes in commercial is underpinned by the cost escalation. So the rents are well below. They have to move at some stage to be able to reflect what's happening from costs of land, costs of builds. Those costs may come back a bit, but nowhere near enough in our eyes. Well, this is my eyes, sorry. In terms of where we'd have to get to make it viable again. So I guess our view is that yes, there may be high interest costs. Your returns at the moment may be impacted, and there's probably a bit of, I guess, headwinds like we talked about, but the pressure on rents has to go upwards from where we are today. And down there, I guess you can kind of see at the moment, which is, I guess, I've been 15 years, is that costs are going up and building values are actually dropping in the market at the moment with your cap rates pushing out, which in 15 years I've never seen that. That's usually always followed the costs of moving. If your costs are going up, your building values are usually improving in value, and that's not happening at the moment. So so in terms of that existing stock, good product, at the moment in terms of assets, yes, some of the good stuff, the cap rates are still low, but we believe there is some good growth into the future beyond that. So forward. No, you're back. So I guess we've looked at, I spoke about was inflation in the rental, and I've just run a small example here, is that this is one of the assets we're looking at the moment. It's under contract for 8.4 million. The rent in year one's 420k roughly. There's CPI uplifts plus 1% every 2 years within the lease plus a market in year 6 and on renewal in year 12. So I've made an assumption of 4% CPI and per annum, which is 8%. So your rent in 2 years, it basically goes from 420 to 453. If you cap that new rental out on the purchase price, it's a 5.4% return. So it's actually lifted quite a bit in terms of the asset value, and I think that will happen throughout time with CPI and market long term. So that's, I guess, the rent review mechanisms in our eyes are quite a key in hedging your inflation, because if you're putting your money in the bank, it's actually going backwards because inflation's higher than your return. At least with your asset's improving in value, if not staying even, and then your return is improving as well. So interest rates. So this is from Westpac, who we now use to do a lot of our commercial funding. The graph on the right there is their anticipation OCR, which is the red line down the bottom, and then the black and the purple blue line above is their 2 and 5 year fixed rates, and where they kind of see them happening around, what's happening with them in terms of what's happening with the OCR and where they see them going. You can kind of see towards the end of the year they're picking that we're going to get basically up around that 3.5% range, and then basically plateauing and then falling away from there to a long-term average of around that sort of 2% mark, which means most of our assets at the moment are around that 2.4 to 2.6 margin on cost of funds over and above the 90-day, which puts it around that 4.5% interest rate. So yes, we see some tailwind in the next couple of years with interest rates, but then we're anticipating that it'll come back once we see a bit of hurt potentially in the market. So I guess that's our view, is to, I guess, take like Owen talked about earlier, it's not a 1 or 2 year view. It's trying to look beyond that and into the future. And I guess there will be some short-term squeeze, but then the CPI, if inflation's still rampant, we're going to pick that up through a lot of our leases with CPI reviews and the likes. So it will sort of manage out over the longer term. Next one came. So this is one of the ones that we've got under contract at the moment, which is a building for the DHB, so government-backed 12-year lease. It's due for completion early next year. The review structure's 2 yearly CPI plus 1%, so we got them on that one a few months back before inflation sort of took off. And then it's got market 6 yearly and on renewal. And in this location here, it's below the hospital, Tauranga Hospital. The DHB's got 3 other buildings down there already. So they're using a lot of this location as their office function, away from the medical base up the top of the hill there. And there's potentially, we're working on one other asset down there as well to go with it, which would look to potentially syndicate together, so be across 2 assets, which will probably put it closer to 25 odd million. So the other one is we've worked with New Shoots on a number of projects. I don't know if many of you know them, with your grandkids or kids. So they're one of the larger daycare operators backed by Milford Asset and some high net worth individuals. Basically, we've got 2 projects underway for them at the moment. That is 10 Tallis Drive, which is Jury, South Auckland, and then 439 Rotokauri in Hamilton. So both those leases are 18 years. They've got 2 rights of renewal of 6. Yearly CPI increases and market every 4 years. Good covenant strength in terms of who's behind them, good lease, good waltz, and good growth structure through the leases. And in terms of the sort of average returns out the side there, I guess we've made there's a lot of assumptions that go into, I guess, a 10-year cash flow. We've worked on 3% CPI increases throughout that 10 years, and then on market 10%, which averages out to about a 6% return on your money throughout that 10 years. And that doesn't take into any capital gains or depreciation factors in terms of improving the actual return and what you'll get. So yeah, those are the couple of things. Work on a couple others as well, which are too early in the pipeline at this stage. But I guess it's more about what the type of assets we're looking at, what we see as the type of assets we want to invest in is that long term, the long waltz, and making sure we're staying in touch with market with those CPI reviews and staying in touch with where rent and inflation's going to. So, thank you.
I'll just quickly close out. Those couple of properties that Dan talked about in the pipeline, we hope to get some information memoranda out in the next month or two. So, as I say, we'll watch out for that, and we'll let those that are interested know when those become available. Hey, the other thing, we were going to do Q&A, but I suspect we've got going to have a mad rush for those Coronas shortly, so let's just leave that. So if anybody has questions for me and Dan or Pete and Matt, feel free to sing out. One thing I was remiss, I should have mentioned, is that as a start-up business for Classic Collectives, being able to leverage off a large organisation that's well-resourced, such as the Classic Group, has been quite a significant thing for us. And that's certainly what attracted me into becoming involved here. And on that note, I really did want to acknowledge that that business has the credibility of that business has been recognised in recent times with the announcement of its strategic partnership with the New Zealand Super Fund. The Super Fund, as you know, is the guardian of our money, lots of it. All the superannuation funds, there's billions and billions of dollars that these guys manage on behalf of the people of New Zealand. And recently they have completed a strategic partnership with the guys at Classic Group. And that strategic partnership, the focus is to acquire and develop land and houses for the people of New Zealand throughout the country. So when you think about an organisation like that choosing to partner with a company based in Tauranga, it's a pretty significant achievement. So I think Pete and Matt, in fact the whole Classic team, because I know it was a team effort to get that off the ground. Well done to you guys, and it's great to be associated with a business such as yours. Okay, guys, time for a drink. Thank you.